ability to pay back. The other aspect that the pandemic has brought about is the need to actually digitize the entire lending life cycle. Now, this is from the time you discover the customer, onboard the customer, KYC, disburse, and even collect the loan. Earlier, the value prop for digitizing the lending life cycle was about lowering the cost of offering a product to a customer, about offering convenience to a customer, so that you could sachet size a lending product and offer it to a borrower. Now, digital lending in itself, or digitizing the lending life cycle in itself, has become essential because there are no longer models, feet on street models that become viable in a socially distant world. It's in this sort of paradoxical scenario that we find ourselves, where some segments are seeing a spike in loan demands, while some segments, especially for discretionary spends, are seeing a complete depression in loan demands, and non-performing assets are spiking in a lot of sectors, that we find ourselves speaking about digital lending very, very different tones now. So that's why we're very lucky to have Uday from ePayLater with us. Uday, can you start off by telling us a little bit about ePayLater's products and solutions and how that's been impacted by the pandemic?
Thanks, Aparajita. First of all, thank you, Ikigai, for hosting this kind of a webinar in topic. Something that has been in the minds of a lot of people, the topics that Aparajita just talked about. And more importantly, lending is so critical to any economy that what happens in lending affects one and all. So, thanks, everyone. And good evening, everyone. So, just to give you a brief introduction about who we are and what we do. Uh, ePayLater, as the name suggests, is a financial technology firm that specializes in providing credit. Again, as the name suggests, it's a deferred payment option. So you buy today and pay later, and this is enabled electronically. So the E in front of the pay later. We started this firm 5 years back. When I say we, it is three of us, me along with two of my friends, way back in 2015. At that point of time, our mission and vision was to make credit more accessible, inclusive, and easy to use. Now, we are talking about a time when uh, things were not as good as they are today. We have come a long way as a country and as a digital economy from 2015, and miles to go ahead. But if you look at 2015, a lot of problems that we were facing at that point of time were with respect to a very abysmal penetration of credit. Now we are talking about and still are talking about close to only around 40 million credit cards in a country which is 1.3 billion, which has a population of 1.3 billion, right? That's under 3% of the population being served by traditional credit instruments. Now, just compare this to any other economy. We always have a tendency of comparing ourselves to the Western world and trying to mimic what they do, and have been very good at it in a number of ways. Something we have been lagging by a huge margin. And if you talk about the developed economies, then we all know that close to 80 to 90% of their population has access to credit, right? Yeah, I mean, we are very fond of comparing ourselves to China as well. Now, looking at the figures for China, the same number would be at around 40 to 50%. So that got us thinking as to how we can change things, and that is how we started this company. So, as I mentioned, credit involves a lot of friction in our country, and access is very limited. Especially, we keep talking about India and Bharat. The Bharat that we talk about has very limited access to credit, right? So the idea was to make people have very easy access to credit with so much penetration of smartphones, and with geo coming in, and internet being accessible to most population. We chose the digital way, and which is what a lot of other players are also doing currently, right? And whenever we talk about any service, then that service would have a digital component to it, right? But what was equally more challenging was it had to be inclusive. The approval rates in our country are abysmally low. Traditional financial institutions have always ignored a huge set of people who are otherwise very good in paying off their debt that they take from their relatives, paying off, making purchases, and paying their bills on time. But because they do not have a so-called credit bureau presence, they have been ignored for a very long time. And credit bureaus, as such, was also a very relatively new concept in the country at that point of time. It had a history of only about 10 to 15 years before that. So all of this made credit penetration very difficult. And what we got together to do is make this entire process very seamless and frictionless. And more importantly, make it available at the point where the customer needs it. So you may want to give a person a credit, but it should be available at the point right there when the person needs it, right? So making available the credit at the point of sale was our intention, and we started with individual customers on online portals. So that was the first of its kind buy now pay later solution that was ever developed in the country at that point of time. And we partnered with some of the thankfully bigger merchants at that point of time, like IRCTC, etc., which gave us a very good initial response to the product. And at that point of time, like when the B2C volumes were growing and gaining traction, we realized why restrict ourselves to just B2C, because at the end of the day, you're doing the credit assessment for an individual. So why not just help out individuals who are doing businesses themselves? And that's where we made a into B2B space as well. So our target segment in B2B has been these small shops, mom and pop, so-called kirana stores, where the individual is a middle class individual selling items from his small 10 square feet by 12 10 feet by 12 feet shop and making a sustenance out of that, right? So that is a little bit about what the product that we offer. It's a deferred payment solution that allows you to buy today and pay at a later date. And we do this for both B2C and B2B customers. We have been very active in adopting technology to make this happen. Some one of the interesting things that happened back in 2018, which changed the digital payments landscape, was UPI. Right? I mean, UPI is a superstar in the payment space. We were able to leverage the UPI technology and make, like I mentioned, one of the important things about credit is not just making it available, but making it available to the person where he needs it, right? So we were able to use the UPI technology and leverage it in a way that wherever a merchant accepts a UPI payment instrument, you could use ePayLater credit for making a payment. So, and again, we were the first to do this back in 2018, even before NPCI launched its own overdraft facility. And what this truly did was made this instrument a completely digital credit card in the hands of every individual who has a smartphone, right? So, just to check the check boxes, a person who wanted credit could access it in less than 2 to 3 minutes from his mobile phone, use it at a point where he wants to use it. So accessible, it's inclusive, and it's very easy to use. So that's been our journey. Interestingly enough, uh, the current COVID-19 situation has presented a lot of disruptions in the way we do business, but it has also presented a lot of opportunities in the way we service our customers and we service our partners. Interestingly enough, our latest foray into technology has been to expand the scope of our business to offer a technology platform as a one-stop solution for our B2B partners, which helps them across the board do stuff across the board, including procurement, inventory management, pricing, getting orders from their customers digitally, and managing their collections and payments digitally. So this is something that has turned out to be a real boon for us, of course, and also we are great that it has been of great help to our partners also.
Thank you for telling us about ePayLater and its products and solutions today. I'd like to begin by zooming out and asking you, what do you think are the macro level impacts on lending in general and digital lending specifically in the short to medium term after in a post-pandemic India?
Sure. The pandemic of this sort has been unprecedented, and we all know that, right? There have been large-scale shrinkage in demand, throwing most of the economies into a recession, and very likely ours too. Uh, all industries across the spectrum have been hit hard. Some harder than others. In terms of lending, these are highly volatile times, fraught with uncertainties and large-scale disruptions. So most so in such times, what most people do is hold their money dear, right? Unfortunately, so. Most lenders have curtailed their disbursements. There is a cautionary wind that is blowing across the space, which is getting people to pause, make sense of what's happening in the industry in which they are operating in, try to gauge the situation before making further disbursements. So this caution has obviously reduced the amount of lending that is happening, and add to that, the disruption in the demand itself, even in the lower risk pockets, is causing a lower uptake for credit as such. Specifically on digital lending, this pandemic also throws up an opportunity in the digital lending space, just like it is doing for digital payments. In some sense, what, let's say, demonetization did for uh, digital payments is something that could be making digital lending in these current times. So people are more and more averse to any kind of physical contact. Social distancing is the norm, and people are looking to do everything and anything that they can digitally. So digital and on lending is the only available option that is available to most people seeking a loan, because nobody is going to a bank to get a loan, and bank staff itself is operating at around 33 to 50%. So in these times, this is a big opportunity for digital lenders. Some sectors specifically are seeing a high growth. These sectors would be food and grocery, edutech, pharma, more specifically some industries like agri-tech, where they are operating on the farm to fork kind of model, are seeing a hyper growth kind of a scenario. So these could be the sweet spots for digital lending in the days to come.
Yeah, I completely agree with you. There's so that there two there's sort of two parallel stories happening both in payments and in lending. One is that demand is suppressed, so it is an industry that takes a hit because it depends on transaction volumes. You do need a certain amount of do need a certain amount of volume and loan book to be able to sustain a business which is viable. But on the other hand, it's finally making regulators see, it's finally making industry see that we need to digitize every aspect. There's no feet on street model for collections that can realistically happen for many, many months, if not a longer time. So from the time that a customer discovers your platform to the time she pays back on your platform, every single aspect needs to be digitized. And it's really heartening that even regulators are sort of seeing this and seeing that KYC needs to be digitized. It needs to be much simpler, whether it's selfie based KYC or video based KYC, so that every kind of user can access a lending product. But that brings me that's the positive aspect. But that brings me also to the initial hurdle that we spoke of, which is underwriting a customer. I have a huge data footprint as a urban upwardly mobile customer. So it's easy to underwrite a customer like that for a lending product. But that kind of rich data set is not an indicator that I will be able to pay in the future, even if I'm an upwardly mobile customer who's using a debt instrument which is basically packaged as an easy payment option. How do you think underwriting models will change, and what do you think underwriting models will look like in post-pandemic India?
That's a very good question. I mean, I mean, things are changing all across the board, and underwriting models and the way we do business of lending is also going to be transformed by the time we see the end of this pandemic. So, just to take a step back, underwriting models specifically are a function of very broadly two things. One, the underlying data that is used to build those models, and the models themselves, what kind of models you use. When we talk about data at a very high level, I mean, the data can be segregated into two types. One is the traditional data that we know of, which has been used for ages together by traditional financial institution and hence the tag. So these data points include the likes of credit bureau, bank statement, ITR returns, financial statements, so on and so forth. Right. So these data sets provide a huge bunch of information uh, about the customer or the entity. On the other side, there's alternate data which is gaining traction. Uh, it's been in prevalence for close to 1.5 to 2 decades now, and with a lot of data being available digitally, this data set has blown up in proportion to how it was before, let's say 2005, right? Now, what is this alternate data that we keep talking about? Basically, anything under the sky, right, becomes an alternate data set. So alternate data set could be, if I were to take an example of alternate data set that is usually used in the lending models, it is about data points pointing to the consumer behavior pattern. So a lot of it is digitally acquired. Most of it is digitally acquired. Uh, and these are data points that help you and guide you in your credit decisioning. So for example, stuff like geolocation, and these are just the tip of the iceberg. You can go as far deep as you want, right? So data like uh, geolocation, yeah, your contact data, and obviously there are a lot of laws and regulations that have come in place to restrict how these data sets can be used and acquired in the first place. But I mean, this is what alternate data is all about, right? Any data set which is outside the traditional realms, right? So when you build a model, you use the more the data, the greater the chances of being able to derive a model that explains a particular behavior, right? So there are various kinds of model. On the one end of the spectrum, you have a rule based or a gating kind of a model, which just tells you if X, then Y kind of a system, which have been traditionally used by financial institutions before these new age lending models came into place. And on the other end of the spectrum, today you see all these machine learning AI based model, which takes a lot of data, a lot of information over a long period of time and makes sense out of such otherwise unrelated pieces of information, right? And in between the two of them, you have models which are statistical models, right? So typically, the traditional models have done a good job. There is no way. I mean, there's a lot of talk around machine learning models, AI models, but we do have to remember that the banks, which have been lending for centuries together, have relied on traditional data, and it is for a reason that they have done that, right? Traditional data does give good results, but the problem with traditional data is the paucity of its availability, number one, and the friction associated with it, right? Now, if you go and ask somebody that, okay, here's, I'm going to give you a loan, you give me your ITR returns, your bank statements, your salary slips, and a bunch of all of this information, the person may today say, I don't need the loan in the first place, which is why the shift towards alternate, right? Uh, so how institutions use this traditional data and alternate data is the more uh, data you have, the better fit that you get in terms of predicting your outcomes, behavioral outcomes. So we are talking about two outcomes here: the intent to pay and the ability to pay. Right. This is what we are primarily trying to gauge when we come to giving out loans. Right. So traditional data, to a large extent, as I was saying, do explain the behavior, Additional alternate data tends to buttress this and give a what is called a lift in the model. So if a model is able to predict a particular outcome with certain certainty, a certain probability, adding alternate data and loads of alternate data would pump up that possibility of uh, getting the hypothesis right. So, very frankly, in our experience also, uh, there are limitations to what alternate data can do. Um, After a certain point, the incremental improvements that you get in terms of your ability to predict gets flattened out, right? However, in these new age lending models where you do not have the luxury of asking customers for a lot of information, alternate data does really help, right? Within a matter of a few minutes, you are able to not just onboard the customer, do the credit assessment, but also make the credit available to that particular individual within a matter of a few micro or milliseconds, right? So that is the power of alternate data. Now, the problem with these models is that these are typically fair weather models. They tend to work really well when you backfit them to a certain data set and try to run them under fair weather conditions, or they may be at best be able to handle a few turbulences here and there, right? But they will not be able to predict a black swan, work under a black swan event. And this pandemic, by any stretch of imagination, is definitely a black swan event, right? This is where models get completely disrupted, right? So the uh, how to so again, going back to the learnings that we have had from traditional players who have been doing this for ages together, how do they manage this? So first, they have the advantage of having applied those models over a very extended period of time, right? So I when prior to my ePayLater stint, I had the luxury of working with few consulting projects with some of the global majors in the credit card industry. So there they do a very rigorous back testing and stress testing of their models, right? But they just don't test it across the variables that are available for at a consumer level, but also across various macroeconomic factors. So let's say the tomorrow the country runs into a recession kind of a mode, how would it impact our default rates and stuff like that, right? Now, the problem is a lot of these digital and new age lenders do not have the luxury of this back testing or stress testing because they do not have the data of having operated across multiple cycles of the economy, right? Uh, so that is one big challenge for these new age digital lenders and the relatively newer players in this segment. Again, having said that,
That's a
this is not, sorry.
That's a really interesting point to bring up here that in a risk model for any lender, there are micro data points like my data points, alternative data points. Do I have more than 500 contacts? Do I have a credit card? From my SMS history, can you make out that I paid my phone bill? How much of a, how large a Netflix account did I take? All of these myriad data points make up my bespoke credit worthiness. And then you can risk price me and tell me, okay, you're eligible for this loan, etc. But a more sophisticated risk model can also have macro risk indicators built into that system. Can you think of any kind of innovation that can happen in risk models post COVID? I know there's never been another COVID for us to be able to accurately introduce a macro level risk indicator like that. But how do you think we'll be able to curate our risk models? Is it that if I belong to a certain industry, say if I belong to travel industry, my immediately as a gating requirement, my risk score becomes very high. Whereas if I'm in a tech industry, say on a gaming platform, I've given you that dating point that I am engaged by a gaming platform, would my risk score become better?
Okay. So yes and a no. Actually, it's both. So in these times, traditional data is going to like credit bureau reports are going to become more important uh, because they have been time tested, right? They have been there in place for a very long time. But the problem with traditional data is they are backward looking, right? So they will tell you how this person has paid his previous loans over a course of last 3 years, 5 years, and they come with a lag, right? If I were to default, or if I intend to default on my next installment, the time it takes for that to get reported and absorbed and communicated to the next lender, that time lag itself is good enough to cause whatever whatever losses that one would incur in lending to that particular entity, right? So, what is the need of the hour is a mix of traditional data as well as real time data, right? So, a lot of people call this nowcasting. We're not talking about how this guy is going to behave, let's say, 1 year down the line. We're not talking about how this guy is going to behave, let's say, 3 years down the line. I'm more worried about now, right? In times of volatility, nowcasting becomes very, very important. And that is where you need to rely on more real time data parameters. So, what could these data parameters be? Like, for example, for businesses, sales, the daily sales or the weekly sales over the course of last 2 weeks or over the course of last 3 weeks is something that is going to be of immense value in conditions like this. Do you see the sales dipping? Do you see the sales rising? We know traditionally that he is used to doing a certain amount of business over this period of time in the year, right? Do you see this guy inching anywhere closer there, or is the sales flattened out, or has it taken a declining trend? That's a very, very valuable information because that tells you how this guy is behaving right now, the minute when you're looking to lend, right? That juxtaposed with traditional data is something that will help in a better decision making. Uh, so another thing I like to state over here is one is the data, of course, and the second is experience in credit is a definite value add over here. So nothing beats a manual or a human intervention when it comes to volatility. When things try to start getting out of control, you need to move the machine and get the man in, right? So I'm not saying it is completely going to be a manual driven exercise, but there have to be interventions that have to be put in place. And here, having a good sound credit underwriting experience is something that is more valuable than any data that anybody could provide, frankly.
Today reminds me of multiple plane crashes that happen when the plane's on autopilot. It's because an extraordinary event happens, and the autopilot is simply unable to handle that. And then when it's only when the humans who are experienced enough as pilots are able to step in that extraordinary circumstance can they save the situation. But this, I mean, this brings me to something about the pandemic, which I feel is the most worrying for lenders. Uh, Traditional data sets, yes, indeed, they are better than alternative data sets. Alternative data sets do have their limitations. But the upsell of alternative data sets, or the real magic sauce was that they were able to bring in borrowers who were completely excluded from the lending cycle, like you said. They were able to bring in the lower income profile, people with very low data points in a traditional sense. They were not able to give a bank statement, not because it was high friction, but it was just impossible for them to do that. What do you think happens to a digital lending business model for offering credit to a new to credit customer, to a thin file customer, if it starts retreating into the safer haven of a traditional lending model, which is traditional data sets, as opposed to alternative data sets? Do you think that a sabzi wala or a tea seller will be able to get that micro credit if she is new to credit, if she is a thin file customer in a post pandemic area?
Sure. So, at a very high level, the approval rates for new to credit would see a decline, in my opinion, in the near term. The reason being that typically how a new to credit model works is there are two ways, very broadly, and there could be nuances of this, but it's either based on a lookalike model wherein you have two pools. One pool consisting of uh, a set of customers, thick file customers who have a lot of data, right? and then there is another set of customers who are thin file customers but have a lot of parameters which match with this group A, with the first group, which is a thick file customers. You build models on group A customers and try to overlay those models on group B customers basis certain assumptions, right? The other way of approaching a new to credit customer, thin file customer, is, as you rightly mentioned, look at alternate data points, right? These could be data points that would be indicating a particular type of behavior, a lifestyle. So what we are trying to do through these alternate data points, and let me clarify. I When I say that traditional data points may not be as useful as, sorry, alternate data points may not be as useful as traditional data points. I'm saying when both of them are present together, right? And if you try to create a model, the kind of lift that you may see from an alternate data set may not be as huge as the kind of lift, as the kind of model that you would have worked on a traditional data set. But that additional lift is what decides the winners from the losers, right? That additional lift may be what determines whether you're operating at a 3% default rate or at 6 or 7% default rate. That is how close the game is, right? So definitely alternate data does make a difference, especially so in case of new to credit customers. So coming to the other model that people use, or entities use for giving credit to new to credit model, is base their judgment on all these alternate data sets. Now, the problem, why I said the lending may come down in this new to credit segment, is for two reasons. One, when you try to build a lookalike model, you know that the original model is working well for you, right? But in these times of troubles, we don't really know if that original model itself will work or not. So, how would you build a lookalike model, right? And second, your alternate data sets have been tested under, again, fair weather conditions, right? You built a complete model which has worked when in the pre-COVID kind of a situation. Will the same data points work in the post-COVID kind of a situation, is something that we are not sure of, right? So, and again, because this modeling of alternate data sets has not been in prevalence for more than 2 decades now, so we do not have a long history of how they would have performed in other disruptions, right? So overall, I think, in my opinion, I think the lending to new to credit customers in the immediate and near term will take a hit, but I'm sure once the dust settles, alternate data sets are going to come in, and modeling of the new normal will stabilize, and the lending to this segment will pick up.
I think that's the most disheartening aspect of the impact on the pandemic, is that there were so many new to credit customers that ePayLater, Simple, etc. were servicing, and now they won't be able to service them, at least in the same manner. Okay, now from a thin file customer to a thick file customer, or to a customer like you and me, who doesn't really need the credit, uses a micro credit as a pay later option. I used to work for a payment aggregator over there, and the mantra for a payment product is it should be zero user experience. No user experience is the best user experience, and no product works as beautifully or as elegantly as a microcredit. I want to order something from Zomato. I just clicked on a simple or an later, and the transaction, the checkout goes through. People in this category don't need the credit but use it very frequently on discretionary spends, Zomato and Uber, etc. Those transaction volumes are taking a nosedive. How do you think a business model which is a credit packaged as a payment option will get disrupted in a pandemic era?
Sure. As you rightly pointed out, so these instruments, like buy now pay later instruments, they serve multiple purposes. They are convenience package in the form of credit, or vice versa, right? So typically, for an individual like you or me, we would already be carrying 3 to 4 credit cards in our wallet. So credit may not be the best use case, but since we are bringing together multiple use cases here, the user's propensity to use that particular instrument goes that much higher, right? Now, how is the lending in this space going to get impacted? Definitely, the drop in the demand is going to lead to lesser uptake of credit. A lot of these online portals are currently not functional. Till about last week, e-commerce was completely disrupted. Even Amazon was struggling to make the deliveries happen, even for essentials. So there has been obviously a lot of dip. Travel as an industry has been completely shut, and a lot of these use cases are around these segments. But having said that, again, I'll go back to the point that the new norm of spending would be digital, and the new norm of accessing credit would again be digital, right? So there is a lot of scope in the days to come for digital lending platform to expand. However, there's a caveat that in the near to medium term there would be overcrowding in certain sectors, like those sectors which are performing better than others, like food and grocery, like for example pharma, so on and so forth. So there would be an overcrowding. Now here business model does play a lot of role on your future prospects. For example, at ePayLater, we have democratized the use of credit through the use of UPI. Now, as a user, as long as I want to spend, I don't have to choose whether I want to spend on portal A, IRCTC, or some other portal. I have an access which acts as made enabled through UPI, which allows me to even buy anything from my local panwala as long as I'm able to scan his QR code and make a payment, right? So we believe that while the demand is going to go down, there's going to be a shift uh, of spending from, like you said, discretionary to non-discretionary spends. But as long as you're able to be you're able to make yourself available at all those points where the customer is continuing to spend, the drop in the overall business numbers would not be as much as, say, entity which is specifically catering to one particular industry vertical or a few industry verticals like travel, tourism, etc. Aparajit, sorry, I am not able to hear you.
I'm sorry, I had forgotten to unmute myself. Yeah, that's interesting today because a lot of pay later options are integrated, like you said, at the point the customer needs, it, just at the checkout point, a simple running pay later. Right? And integrating them now with merchants which are for discretionary spends, those merchant categories will take a very, very long time to come back to their feet. And especially, I think, because even in the example of credit cards, Indians don't really use credit cards as a debt instrument. They use it as a payment instrument. Very few people use it for revolving credit, a credit payment to use another credit payment to use another credit payment. So the user who doesn't really need credit isn't going to go through the hassle of doing a massive KYC process or the friction of onboarding or the friction of providing any traditional data set. She just needs the credit then, and she primarily needs it for essential payments. Which brings me to how do you think digital lending models will change on the business side? How do you think it's going to change for MSMEs, their access to credit? Specifically because some of these MSMEs which work in a discretionary space, they're not going to be credit worthy for a very, very long time. How do you think they will have access to credit, or do you think they're just going to be outside the net for a long time?
Sure. See, for industries where the impact has been low, they will be able to bounce back faster, like I mentioned, like food, grocery, pharmacy, etc. And even though the uptake of credit and the disbursements would be low to start with, eventually it will catch up to the pre-COVID kind of a situation. For industries which are lagging behind, like travel, tourism, etc. Now, the way this is going to evolve is there has to be a uptake in the demand to start with, because unless and until the demand is created, these businesses by themselves will not be able to perform, even though they may get the loans. Hypothetically speaking, if somebody is out there to disburse loans, even after taking those loans, they may not be able to survive for long if the demand is not going to pick up soon. All right. So once the demand picks up, the way things are going to evolve, in my opinion, is the lenders are going to go back to their own customers first, right? So relationship over here would be something that would become very important. For a customer to be able to take a loan from a particular entity, it would really help if he was serviced previously by the same entity or has had a long standing relationship. So relationship based lending is going to be the next step in offering credit to these entities. And the other way of approaching this is again having more insights and visibility. So, what is scary for a lender is to put your money out there and not have enough visibility of how things are going to evolve. Now, the one way of mitigating that risk is by looking at data and alternate data and all of that. The other way is to get involved more in the value chain. So deeper integrations into the value chain is something that may really help at this point of time. For example, if you're applying to if you're offering credit to a particular entity, can you in any way get integrated more deeply into the entire value chain so that you are able to mitigate some of those risks? As an example, I will probably talk about what we are doing at ePayLater. So, like I mentioned, our core focus is on the Kirana, but over the course of last 1 year or so, we integrate ourselves more deeply in the entire value chain, starting from the supplier, distributor to the Kirana, and now we are getting the Kirana also in touch with the end customers. So, what this allows us to do is not only give us a 360 view of his entire business. We don't just know his demand, but we also get to know the supply, right? Which really helps in these times because the disruptions can happen anywhere. Of course, there's a demand disruption, but there's an equally big supply disruption as well, right? So integrating yourself more deeply into the value chain really helps, and that is something that could help institutions which are lending to the MSMEs at this point of time.
You also think that lenders whose business model is built on microcredit, sachet size credit, will fare better because at least the risk is, even if your loan book is large, at least your risk is spread out because you haven't set out large ticket size loans. Or do you think that now a lot of lenders will start recalibrating and saying, okay, we're going to reduce the general ticket size of our loan agnostic of how we underwrite the customer?
So, on a standalone basis, you're correct. On a standalone basis, a smaller ticket loan is less risky than a bigger ticket loan. Obviously, if I'm lending 50 rupees, I'm taking a lower risk as compared to lending, let's say, $1,000 to a friend of mine. But that is where the ease of small ticket lending ends. Essentially, by giving out a lot of small ticket loans, you're creating a portfolio, right? Which becomes very difficult to manage, right? So think of it this way: when I go out to make a recovery or a collection, instead of owing to, if I had given 100 rupees to 10 people, I would have had to reach out to only 10. But instead, I've given out 10 rupees to like 100 people now, right? So my recovery and the collections and the effort involved becomes that much bigger, and hence managing a very good book or a decent book of lower ticket loans is very challenging. That is one, and the cost involved also go up because the collection effort goes up. The second thing, the cost of onboarding is again a point of friction, and this is precisely the reason why traditional lenders have stayed away from small ticket loans, because there's a cost involved in acquiring each customer and being able to service those customers. Now this is where digital lenders like us stepped in. So what we did is we brought in technology so as to be able to handle the scale of a large number of small tickets, right? Automated a lot of processes, brought in machine learning models or AI based models for collections, right? Which tell you the right time to contact a person, how likely is that person to make a payment, etc., etc., basis which you are able to streamline your activities in a way that you have the highest payout for every buck invested in that particular process. So, just to answer your question, would everybody foray into the small ticket lending? I do not think so, because it takes more than just a lending capability to be able to do that, because you have to get the entire tech stack and everything going? Would it be something that would become the norm, let's say 12 months down the line? I really don't know how things would pan out by then, but yeah, I mean, it comes with its own set of challenges, but it is a different ball game altogether in the lending space, and it has its own challenges. But overall, if you're able to manage these challenges by the use of the right kind of technology and analytics tools, then yes, it is definitely a good business to be into, because a person's propensity to default on a smaller ticket loan is lower than that of a higher ticket loan. Having said that, again, another element that is very, very, very important in small ticket lending is ability to manage the fraud risk. So for a long, smaller ticket loan, nobody again is going to go through all the friction of providing 100 data points. So you're working with very, very thin set of data, and the when you do that, and the checks number of checks that you do typically go down, then you're exposing yourself to more fraud. So small ticket lending is as much a play on mitigating frauds as it is about getting your credit model right.
Do you think that more innovation is needed in driving down customer acquisition costs or even lifetime customer costs, especially like digital KYC, digital onboarding? There are a handful of ways in which you do digital KYC right now, like uh, a liveliness test in a live selfie or a video-based KYC, but these are extremely expensive tests. Do you think more innovation is needed in this stage to drive down that customer acquisition cost and therefore have the ability to offer that microcredit which makes any kind of unit economic sense?
Sure. In fact, all these technology innovations, what they're doing is they're bringing down the customer acquisition cost. While it may seem like a video KYC is expensive, it is definitely much cheaper than sending out a feet on street out there to get that done, right? Uh, More so now than ever, because the cost of operations have gone up because of all these new regulations that you need to adhere to, of social distancing, maintaining staff, etc. So the operating costs have in fact gone up more now as compared to earlier. So in these times, the contactless kind of onboarding through digital KYC, etc., are something that are going to bring down the cost. And over a period of time, these costs have come down substantially. So the cost of doing a video KYC or a digital KYC is far, far lesser. I mean, about 10% of probably the cost involved in sending out somebody out there on the street to do the job for you. Moreover, similarly, the same thing happens in collections as well. So, compare, just suppose today's AI-driven collection models, like the one we use in ePayLater, to how the industry used to operate, let's say, in the traditional sense. Instead of sending out your collection agents out there in the market for all small and big outstanding loans, you can very easily through your models pick and choose which customers to approach how, and that brings down your cost significantly. So in these times, these are going to become the game changers even more as compared to earlier.
I think we're running very, very short in time. Vijayant, you want to take a few questions from the audience? There are so many more questions we had to ask you. Unfortunately, we are very close to the end of this webinar, so we have to move straight to audience questions.
Sure, Aparajita. So the first question that I would like to ask Uday from the audience is, how do digital lenders build in an event like COVID-19 in their permanent risk modeling, especially when incomes of individuals and revenues of businesses are impacted by non-business factors?
So the short answer to that is we don't. Nobody can model a black swan event and uh, create a model that looks out for that. So typically, how it works is you have these are two different kind of planes altogether. So you have a plane on which you have been operating till now. Now the plane has changed altogether. Best way to go about it is to recalibrate your model, to start afresh, to start looking at data afresh, to start looking at the outputs that are getting generated by your models afresh, and start recalibrating. If you try to fit a model for both the planes, it would not be successful in either plane. You can at max, at best, have flags that or some kind of cues that tell you that the plane is changing in the model itself, which will give you some early warning signs. But frankly, I in my career so far haven't seen models that work in such drastically different environments.
Right. So just continuing with the idea of risk modeling, another question relates to how do lending platforms that leverage the help of AI in their risk modeling account for biases in the AI that may end up resulting in situations that are contrary to achieving the objective of accessibility, credit access, and financial inclusion.
Okay. So whenever you're building a model, it's a trade-off that you're doing. So in a statistical sense, there is type 1 error and type 2 error. So, but purely from a layman perspective, what we are saying is by when you're deciding to say give credit uh, to a person, you may so rather let me put it this way: rejecting a guy who is otherwise a qualified person, or accepting a guy who is otherwise a not qualified for the loan, is the kind of trade-off that you have to do. The way you operate on any model is you try to minimize these losses from a business perspective, because if you lend to a too larger base, you would be able to generate revenues, but you would be losing a lot of money in the defaults and delinquencies. But if you try to restrict the funnel to a very very small proportion, then the business that you do and the losses that you incur may not be justified at all for doing that business in the first place. So you have to find a sweet spot between the two, so that you are able to generate enough business which not just takes care of your revenues but also for your offsets your losses. So to answer your question, the AI have a bias. Every model has a bias. So it's all about how well tuned the model is to find that sweet spot, so as to avoid these kind of errors.
All right. Thank you for that, Uday. So there's a couple of questions relating to the data points that lending platforms would gather. So the first question is, how would you address privacy concerns for these alternate data points that are used for assessing credit worthiness, especially when users many times don't even know what these data points are?
Right. So thankfully, a lot of this work is being done by players and governments who are aware of such things happening. So whenever you introduce, for example, a new app on Play Store, for example, there are a number of checks that Google Play Store itself puts in place as to you are supposed to say why you need the data for your business, and only if you're justified in asking for the data will you get the permission to access the data. Moreover, today, unlike the earlier Android versions, whenever you are being asked for a particular data point, you have to give the consent, get the customer's consent to collect the data, and the customer also has the option of turning it off at any given point of time, and you know exactly what data you're parting with for what kind of service, right? Moreover, there are the regulations are also keeping step, albeit a little slowly, and there are a number of regulations that are coming up which are protecting the privacy issues related to individual consumers.
Absolutely.
So if I can just add to that, it's an entire webinar in itself about how the new personal data protection law will actually disrupt any kind of data, any data-based business, including digital lending. So I think there is some runway before the PDP, the Personal Data Protection Law bill becomes the law. But once it does become the law, it is a huge disruptive force once the consent requirements, the purpose limitation requirements all kick in.
Absolutely.
Right. So the last question from the audience is again like relates to the data points that lending platforms gather. So it asks, can financial institutions that gather data about the credit worthiness of businesses be made to share these insights with other entities for the purpose of credit assessment?
Okay, so frankly, this is something that is covered in the individual contracts that the individual gets into with the financial institutions. So the right way of going about it is to go through the fine print, because in some cases the data could be used for sharing with external agencies as well. And there are examples of such data which each and every entity has to share with external entities. Like, for example, the basic data set that you provide as a user for any lending institution has to necessarily be passed to the credit bureau, right, for pulling your credit report. So there are certain data points which are the norm, which necessarily need to be passed to external entities. The only question is, are these entities by themselves regulated? If so, they are working within certain boundaries that have already been defined. Otherwise, there could be issues of your data getting sold to third-party agencies, etc., wherein it could be misused. But in any case, PII-based information, there are various regulations that companies need to abide with to be able to operate.
All right. Thanks, Uday. So that's it in terms of questions from the audience. Aparajita, are there any? Is there any final questions you want to ask Uday?
No, we've taken 1 hour over this time.
Yeah. Okay. Ratul, then I'll hand it over to you.
Thank you so much, guys. That was a lovely session. I learned a lot for sure. I hope all of our viewers did as well. We do have a session. We do have another webinar on GST and e-commerce scheduled for tomorrow. Registration is mandatory, and you will find the registration link on in the chat. So, thank you, Uday, so much for your time and learning from you going forward as young.
Thanks everyone. Thanks for your time, and it was a pleasure being on the webinar.
Thank you, everyone. Thank you.